Hello everyone, I am Dr. A. Nagalakshmi, Assistant Professor, Department of Commerce with Finance in Dr. SNS Rajalakshmi College of Arts and Science, Autonomous, Coimbatore. I am here to explain a concept, break-even analysis in the course Cost and Management System. So, before going into the topic, we should know what is meant by break-even analysis. So, a business is started in the motive of profit maximization and wealth maximization. At the initial stage, that is at the time of starting the business itself, we cannot expect the profit. So, the owner or the proprietor has to frame a strategy in order to make the business break even. That is, no profit, no loss. Normally, a newly started business will take minimum 3 years to 5 years to get stabilized. In the meanwhile, if the business is in the break-even point, then it will start growing up slowly. Now we can see what is meant by break-even analysis in detail. The break-even analysis, it is also a financial tool used to determine the point at which business revenue equals its cost. At this point, the company neither makes a profit nor incur a loss. It is called break-even point. So, break-even analysis, it is also a financial tool in order to see the revenue equals to its cost. So, cost and the revenue should get equal. That means it is neither making profit nor incurring loss. That point is said to be break-even point. Now we can see the key concepts and definitions. So we should know what is meant by fixed cost. We should know what is meant by variable cost, sales price per unit, variable cost per unit, contribution margin. Okay, now we shall see what is meant by fixed cost. These costs that do not change with the level of production or sales volume. So, for examples are given: rent, salaries, insurance, depreciation. So, we have hired a building for making the production. If the production is 100 or if the production is 1000 units, the rent what we pay will not change. Likewise, the salaries given to the employees will not depend upon the volume of production or volume of sales. Those expenses are said to be fixed cost. Variable cost, it's vice versa. Costs that change directly with the level of output. That is raw material cost, packing cost, direct labor, shipping. So how much units you are going to produce, that much raw material we have to purchase. If it is 100 units, we have to pay for some 100. Example, it may be 100 units of raw materials. If you are going to make the production of 1000 units, we need 1000 units of raw materials. So, the cost will directly change with the level of output. Likewise, the third one, sales price per unit. The amount that which each unit of product is sold. So, for the price what we fix and at what amount we are making the sale of a particular product, that is said to be sales price per unit. Next, variable cost per unit. Per unit means making the calculation for 1 unit. The variable cost incurred to produce 1 unit. So, if you are making a production of 1000 units, what is the cost incurred for producing one piece, 1 unit of the product? That is said to be variable cost per unit. Next is contribution margin. So, this is the amount remaining from sales revenue after variable cost have been subtracted. See, they have given a formula. Contribution margin per unit is equal to price per unit minus variable cost per unit. Okay, these are the key concepts and definitions of break-even analysis. Now we can see what is meant by break-even point and the formula for it. Break-even point in units, that is in quantity. This tells you how many units you must sell to break even. So in order to equal the revenue and the cost, this much units has to be sold so that the company will meet a break even point. So that quantity can be determined using this formula. Break even point units, fixed cost divided by contribution margin per unit. The next formula is break even point in terms of sales revenue. That is the first formula in terms of units, quantity. The second formula is break even point in terms of sales revenue. That is in the form of cash, rupees. Sometimes we want to know how much money, revenue, is needed to break even. So break even in terms of revenue is equal to fixed cost divided by contribution margin ratio. Whereas C, that is the formula is contribution per unit divided by selling price per unit. Now we are going to see an example. Let's say a small bakery sells cupcakes. Fixed cost incurred is $10,000 per month. Selling price per cup is $5. Variable cost per cup is $2. Now, the first step is to calculate contribution margin per unit. We know that is previously we saw the formula to calculate contribution margin per unit. What is the contribution margin what is the formula? The formula is selling price minus variable cost per unit. Selling price per unit minus variable cost per unit. That is 5 minus 2. 3 rupees is the contribution margin per unit. The second step is to calculate break-even point in terms of units. So, there is a formula. What is the formula? Fixed cost divided by contribution margin per unit. So, 10,000 is the fixed cost, $10,000 is the fixed cost divided by 3. That is 3,334 cupcakes to be sold. The third step is to calculate break-even point in terms of sales revenue, rupees. First, we should calculate what? We should calculate if we should apply the formula contribution margin per unit divided by selling price per unit. So, we get 3 divided by 5, 0.6 is the amount we receive. Next is to apply the formula. We will be applying the formula fixed cost divided by break-even point in sales revenue per unit. That is 10,000 divided by 0.6. That is $16,667. So here the bakery must sell 3,334 cupcakes or make that is $16,667 in sales to make the break even. So it's a simple example given in order to calculate the break even point in the aspect of units and in the aspect of sales revenue. See, this is that is visual representation of break-even point in sales revenue. See, a break-even chart typically includes x-axis and y-axis. X-axis is units sold and y-axis is dollars, that is cost and revenue. So the lines will be total revenue line, total cost line, and the intersection line will be there. So total revenue starts at 0, increases with sales. Total cost starts at fixed cost, increases with volume. The interaction is the break-even point. Here the two lines will interact at one point. That intersection point is said to be the break-even point. Now we are going to see why the break-even analysis is important. So it is important for pricing decisions, profit planning, risk analysis, feasibility. For these purpose, break-even analysis is important. For price decisions means helps to set the price based on cost structure. Profit planning helps forecast profit at different sales levels. Risk analysis shows how sensitive your business is to change in volume. And feasibility determines whether a business idea is financially viable. Now we are going to see what is the difference between break-even analysis and margin of safety. So margin of safety is how much sales can drop before you hit break-even. So margin of safety is equal to current sales minus break-even sales. If current sales is $20,000 and the break-even point is $16,667, here margin of safety is current sales $20,000 minus $16,667 break-even sales. So we get 3,333. So this tells us how much cushion we have before increasing the losses. Now we are going to summarize this break-even point. Break-even point where total revenue is equal to total cost, fixed cost, cost that do not change with volume, variable cost, cost that increases with volume, contribution margin, selling price minus variable cost, break-even point in terms of units, fixed cost divided by contribution margin per unit, and break-even point in terms of revenue, break-even point revenue. Thank you. Thank you so much for the patience listening.